Welcome to TheoTRADE. This is Don Kaufman. It's March 20th, 2024. The Fed day has come and gone. S&Ps, they're off their highs of the day. But I got to tell you, there's some irrational Fed exuberance playing out in this marketplace because once again, it looks like the Fed has kind of failed to maybe curb some of those inflationary markets. So let's actually break down some of the trade activity because I'm going to tell you right now, in this evening's video, there are some changes afoot in this marketplace, and I want to point out exactly what I see quite detailed. One of the first things that I want to point out, it's not so much about price action in the marketplace. I'll come to that in just a moment. One of the first things I want to bring to you, the advanced decline line. So we hit very high degrees of correlation. And that's something I've talked about extensively on some of the weekend updates. You know, if there's a sign of change in the marketplace, it's going to come by means of a higher degree of correlation. So one of the first things that I do want to point out, it doesn't matter whether that correlation to the upside or the downside. Okay, what I'm trying to point out in here, okay, is just a stark contrast to some of the trade that we've seen as of late. Now, granted, today is a bit of a Fed day. And as I said, it's a little irrational Fed exuberance over here. Like the Fed they didn't really change too many statements. They were very, very neutral in the stance, yada, yada, yada. Like, look, everybody's going to have conjecture about what they thought about the Fed. The bottom line is, you know, you don't have to speak with words. Look at some of the price action in here. The price action in here simply says, like, look, you know, it doesn't seem like the Fed is containing what could be some inflation risk. So maybe, I don't know, maybe the Fed, their dual mandate doesn't necessarily contain asset prices. Asset prices loved it, and they're rallying right now. But the critical point is, again, higher degrees of correlation. And I have to point out, as I said, changes to the marketplace because as of late, you know, we've constantly, day in and day out, seen what I'd term a slop fest. It's been like 50-50 advanced decline lines. It's kind of march a little bit higher in this marketplace. Now, that is one aspect that is of, you know, fairly critical change. There's another aspect that I want to point out, and this one is not necessarily completely dead yet, but has definitely died out, if you will, in the last few trading sessions. Let's cruise over to Nvidia for a second. So Nvidia, you're like, oh, it's up today. Yeah, but if you actually take a quick glance at it, there's no more gamma squeeze going on in here. There's not like this fierce call buying activity and this driving force ultimately behind Nvidia. Moreover, so I looked around a little bit in most of your tech stocks. And again, you know, today is a Fed day, but yesterday wasn't. And yesterday saw incredibly low options volume overall in the marketplace. The marketplace in the month of March, okay, has averaged in March of 2024, has averaged right just shy of about 50 million contracts. Yesterday, we only did 38 million contracts. Like, whatever, it was before the Fed. Look, today, granted, you know, that contract size is going to pick up. You know, unequivocally, the contract size is going to pick up. But what you're not seeing in the marketplace, if we start looking at some of the tech stocks, there's no, like, again, fierce trade activity, you know, call side of it. Okay, even Meta, there is some call trading, but it's just, when I say not fierce, 1.2 is our sizzle index, which basically means that's like average versus the previous 5 days. And quite frankly, okay, the previous 2 days has been light and fluffy. I mean, there's not been a lot of activity. So we'll be on the lookout specifically for this and for change. And if I do see some further change in there or some call activity coming back in, okay, I'll be more than happy to point that out. But for right now, again, stark contrast in this marketplace, right? Because again, you've got this higher, if you will, correlation factor. You've got lack of the driving factor being Nvidia right now. Other asset classes have clearly come back to life. One of the ones that to me is kind of shocking is the financials. The financials, huge bid to the upside. In fact, if you take a look at auto expected moves, we're actually outside the upper edge of expected move specific to the financials, right? All of a sudden, they just came to life. Interestingly enough, the energy sector, which has been incredibly strong lately, it's just kind of meandering a little bit this week. But this is where I say I think that this is incredibly, incredibly inflationary. That is the energy sector as a whole going up. All right, switching gears a little bit. Dollar got crushed on the Fed. That's where I was actually saying, again, the Fed possibly has failed us. Okay, the marketplace seeing again some sell side activity specific to the dollar. I wouldn't be surprised though to see some of this reverse back higher. Okay, and one of the interesting things, and of course, is gold. And gold should trade higher with the dollar down, but gold very close to breaking out to the upside again. Now, as I said, switching gears completely, realize the bond market, today's a Fed day. What did the bond market do? Absolutely nothing. Because again, in the Fed dual mandate, nothing really changed in terms of interest rates. And what are they going to do? Okay, not really cut here nor there. All right, kind of left us in a little bit of a lurch. We'll wait for some data, but at the exact same time, and the dual mandate, remember, the dual mandate is about employment and it's about interest rates, about curbing, obviously, inflation. One of the mandates, though, is right now is are they curbing inflation with asset prices and possibly asset bubbles popping up over here? That's why I say maybe the Fed has failed on that particular front. But I am perplexed by the lack of movement inside of the bond market. Moreover, okay, the volume in the bond market, I have been through many a Fed meeting in 25 years. I don't think that I have ever seen volume, though, that light in a bond market on a Fed day. I mean, it's anemic out there. I even took a look at the notes. Like, all right, so the volume's a little bit higher than it was like on Tuesday, but that's exactly the point that I'm trying to make over here is nothing is exactly rocking on the front of bonds. It's just asset prices just kind of continue to climb a little bit. Okay, obviously you got a little bit of a volatility crush. This is something that, if anything is incredibly bullish on the screen, outside of the fact the S&Ps are up, it's the first major volatility crush we've seen in quite some time. And again, that unto itself, okay, is extraordinarily bullish in the very near term. Last but definitely not least, I'd like to cover a little bit about the SPX, all right? So the SPX, each week we actually dig into the SPX and we look at what's termed expected move, right? So here we are on this Wednesday with the S&Ps closing, all-time high. So we're just it is the closing high, okay, but we're just above, if you will, okay, the upper edge of the expected move. And the upper edge of the expected move is right around 5,200. Okay, where are we right now? 5,220. Listen, that is critical because what we're seeing, and that's why I mentioned the volatility prior to, a crush of volatility with markets accelerating beyond the expected move. Okay, look, this just simply is one of two ways. This is one of the most dangerous places that you can possibly be, okay, on a Wednesday, especially late in the trading session. You're already outside the expected move, and the expected move this week, it's not meager. It was an $81 expected move. Okay, so lo and behold, right this second, if you look from where we started, okay, to where we presently are, that is not 80, it's exactly a $100 move to the upside. We're 100 S&P points higher. That to me isn't per se the cause for concern. That's just some, pretty critical move to the upside. Cause for concern is you're already outside the upside, if you will, of the expected move. And here is where everybody on the street, they have to hedge in the dynamic of the marketplace. Okay, this is where instead of a squeeze coming from an individual product like, Nvidia leading markets or Microsoft leading markets, that's not what's leading markets. In this particular situation, it's the S&Ps. And the S&Ps at this point, okay, this is where things can actually spiral to the upside. Buying can continue to get buying. What, okay, you would need to see literally an overnight trade would be a fast pullback okay, right to the 5,200. That would be the S&P futures pulling back. There is the closing bell. But you would need to see in the overnight trade, the S&P is pulling back just about 20 handles. Okay, we need to open tomorrow on the upper edge of expected move, or you could see follow through to the upside, right? That is, again, extraordinary. It is a vicious move to the upside. 2 days left inside of the trading week. You're already 100 handles higher. But none of that matters at this point. And all that matters is we are to the upside of that expected move. And that's where hedging activity kicks in and can drive that move to accelerate even further. Thanks everybody for joining us here at TheoTRADE. Have a wonderful evening. Bye-bye.